Adrian Lim, Investment Manager, Asian Equities at Aberdeen, one of the largest India investors. Adrian, good morning. Always good to have you on the show. But, I first wanted your thoughts on India's IT sector because you have a large overweight here and you have been invested for decades here and have made a lot of money. Do you think this current trend that we are seeing is a bit of a reversal for Indian IT in terms of fortunes, or is this just another buying opportunities? In short, do you think Indian IT sector is getting derated, or will it overcome the current challenges?
Well, if you take a long-term view, in terms of ratings-wise and valuations, Indian IT has derated over the last 15 years or so. And the reason for that is as it grows, the growth rates moderate to a more modest level, and you get these ratings that follow suit. And that's quite normal for any company in the technology sector which scales up. The other challenge that I think that is more crucial rather than the derating, and I don't think it's going to substantially derate from here. I think these levels are comfortable for what it has. The other thing that's more important is its business models. There has been a lot of change in the Indian IT sector offering over the last 5 years, over the last 8 years, and we see many of these companies try and change to adapt and adopt and become increasingly more relevant, or at least as relevant as they were before, to their customer base. We hear terms of automation, we hear terms of digitization, disruptive technology, and I think these are interesting things that the IT companies, which used to do slightly different work in the past, will have to adapt to. They do have to be more proactive with their customer needs. They do have to anticipate their customer needs and not just fill out requests for proposals or bids or auction bids for jobs. And I think that's the thing that will challenge them and will stretch them over the next 5 years or so. Having said that, they do have a huge talent pool. There's a lot of training and recalibration going on, especially among some of the stronger players in the industry. They still have a lot of cash and resource as backup to fund this transition. So we think that they will come out on top. In what form and how the specifics of that is difficult to pin down at this stage. But we think that there is a lot of quality in the IT companies, and this derating is within the range of valuations we've seen for the last few years.
Okay, that's the debate on valuations, Adrian, that I wanted to take up with you. Good morning, and thank you for joining us. Valuations are still for the big boys between, 15 and 20 times. And earnings growth is in single digits, probably even in middle to high single digits, if that. Would you worry, therefore, at this point in time, till they once again show double-digit earnings growth, or till valuations come down closer to their earnings growth, would you stay away from them or even tweak some of your holdings?
Well, we always tweak at the peripheral of our holdings, but our core thesis remains the same. We have quite a bit in Tata Consultancy, we have a bit in Infosys, we have a bit in Emphasis, and that's the three key players that the ways that we've decided to take exposure within the IT market. On your question on whether the ratings come down to meet current levels of expectations of growth, or whether growth inches up to to validate what the market expectations of growth are, I think in the medium term it'll be a bit of both. The difficulty and the challenge is that there are parts in almost all the key players' P&L that are growing in excess of single-digit numbers. So, in excess of 20%. And that's the key issue here. Not all in IT is the same. There are bits that are growing very quickly. There are bits that are cannibalizing some of the old business, and there are old business bits that seem like they are on their last legs but are still growing reasonably well. So the interesting thing is to actually understand the landscape behind the revenue drivers and having a clearer view over the next 2-3 years in the medium term, how those pan out. But to answer your question shortly. It's I think the growth rates will inch up from here, and I think valuations in the short term could see some weakness from here. But as a business model, these are players that we think will do well in the disruption that is currently going through.
Adrian, good morning. We'll come back to individual stocks in a bit, but what's your view on what kind of upsides emerging markets and India could see over the next 12 months? Because generally, when the US growth is strong and when the Fed raises rates, that bodes very well for emerging markets, similar to what we saw in the 2004 period. What would your view be?
Yeah, I think there is scope for positive improvement, but as you can see, looking at valuations and some of the resilience of the capital markets in emerging markets, some of that uptick will have to wait a little longer for where there are clearer signs of more sustainable levels of recovery or strength from the US economy. I think we are at a stage where it is very soft in the emerging market space. There are segments that will do well, but it's extremely difficult to call exactly and give you a data point on what growth expectations exactly should be come the end of December this year.
Okay, Adrian. So coming back to India and your own positioning in Indian market. Two sectors where you have decent weights have been materials and healthcare. Now, materials have done well, as we all know, and that's globally. But healthcare has seen a bit of a decline once again in India, in line with IT. Incrementally, how would you approach both these sectors?
Yeah, healthcare and materials are not our largest positions. They are not even in the top 3 of our exposure weights. To give your viewers context, IT, banking are by far the 2 largest positions. But you are right, healthcare and materials, we do have an overweight to the benchmark exposure, although they are much smaller than our IT and our financials position. Within pharmaceuticals itself, there are periods of time where it is an industry where implementation or regulatory risk is actually pretty high. There's a lot of competition in the space, and there's a lot of protectionism, especially when markets are not, or economies are not doing well. So what we see within the pharmaceutical segment is some of that stress over the last 1-2 quarters or so. It doesn't mean that it's a bad sector to be in. We have key positions, larger positions in Sun. We have some position in Lupin as well. And these are companies that we think will be able to withstand some of these short-term or medium-term stress points. But you do have to do your homework and get comfortable with what you're buying. So I think that it's a time to have a look and see whether they meet your requirement and you feel comfortable with it. But it doesn't ring the demise of the healthcare industry at any point in India. With respect to your question on materials, actually we have a quite skewed position there. It's actually in cement and in paint. It's not materials as in it's not in mining materials or construction materials as such, other than in cement, and that feeds into the general strength of the construction and renovation markets, and a little bit more broad-based, not just in driven by infrastructure projects or by public sector spend, but a deeper, wider base into the private sector, into retail and individual consumption as well. And cement, unlike most of materials, is not so much driven by global economics as it is by domestic economics. And cement, as you know, you do need to have a strong, effective, efficient physical distribution infrastructure. And that's the thing that we think will give the cement players that we have invested in a leg up or strength within an environment like this one in India. Not so much the global market play.
Okay. Your consumer pack, what would that include? Would you now want to change that into perhaps including some of the outstanding performance in auto ancillaries as well? They're not strictly consumer durables, but feed into them. How are you looking at the entire consumption basket? Does the India rural consumption story excite you? How do you think about consumers?
The Indian consumer is very exciting, but the Indian consumer doesn't consume. Cars is a big ticket item. It's visible. People have a, like most consumer items, people have an emotional appeal, and they think they can pick the winners, and that's actually quite tricky in the auto segment in India. The four-wheeler market has got 2-3 big groups in India that do very well, but it's a very competitive market space. The two-wheeler markets has more oligopolistic strength, but it's still a very competitive market. So what we do have in the past is we have some auto ancillary in the form of Bosch, Bosch India. We have some auto via Hero Honda, and we've held them before with Honda and without Honda as well. And we think that in the give and take of the auto and the auto ancillary segments, these are two positions that we feel confident that they have the resource as well as the technology and the people to continue to compete. There are periods of time when you will get a rush into the auto segments, and there will be big winners and big losers at different points in time. But given our long-term view, and we tend to hold things with a 5-year view or onwards in mind, we think that these two examples will stand in good stead. We have a lot more in consumer staples, though, than we do have in consumer discretionary, and that's a more diversified basket as well. We have the MNCs, guys like Levers and Nestle, but we have quite a bit in the local champions, or the now ex-Indian champions as well, in Godrej and Imami and all that.
Yeah, in fact, I was going to take that point forward. You've liked FMCG for a while. You have not only HUL, you've liked Asian Paints, and now you've recently added Imami into your portfolio too. Do you see a lot more value in some of the smaller FMCG companies compared to the bigger ones?
Actually, value is quite difficult to come by in consumer staples. If you look at a PE, on a nominal PE basis, it's a sector that's well priced. It's a sector that investors like, they empathize with, and they identify with. So, and it's also a sector that people do like in this part of the cycle, where demand is soft, and you look for resilient businesses. I don't think there's much. I don't think there's so much value in terms of pricing. You can find spots of it if you go down the scale, but there is a compromise as well. We need consumer companies that have got strong brands, strong distribution, strong development resource, and have a proven ability to market and communicate those values to their consumer base. They need to understand stocking, they need to understand pricing, competitive environment, and they need to keep a strong, relatively stable team of senior managers that know their work. And I wouldn't go down. I wouldn't buy a cheap stock just for the sake of getting something lower priced. It has to be of decent quality, good quality, and that's something that that you can find in India, but valuations not so much at this point.
Okay. No, but there's no question of a cheap stock now, isn't it? The question that we are asking you generally, macro, are you buying at all in India now, or are the valuations scaring you?
We are maintaining our weights in India. The thing is, we pick stocks, and stocks move in relative valuations to each other, and there are points in time when you can take profit from certain counters. By and large, we haven't been taking much profit from India at this point in time. It's been sideways for a while now. We like the quality of what we hold, so I think at this stage, looking back even over the last 6 weeks or so, we've been maintaining these weights. We haven't been aggressively adding or deleting from our positions in India.
Okay, since we're talking stocks as well, Adrian, just one final question from my end. One stock which has done remarkably well for you is Piramal Enterprises. I think it's doubled since your entry. What are the triggers here? I mean, are you looking to add more?
Well, it's interesting, right? I think Piramal is an exciting group. It has gone through, Ajay and his family has gone through evolution of the group's businesses, and has been at points in time being able to do deals which really optimize the opportunities that are available to it. It has morphed over the last decade or so from a healthcare provider through its pharmaceuticals into a business that's now well positioned for the evolution of the financial sector. So that's something that that's interesting, that excites us, and you know, we are watching closely some of the events that happen at the group. But at this point in time, it's done well. I don't think we'll be adding to it. We'll be adding to it aggressively. It's now time for it to deliver. It needs to deliver on its plans to make sure that they do have a level of management resource and bandwidth to absorb all these changes and to deliver on some of the aspirations that they have talked about.
Mm-hmm. Well, let me come to financials. You've always held HDFC and Kotak as your favorites, more lately Kotak as your best investments. But India is growing financially in several other areas. The biggest craze now is housing finance. You have HDFC, of course, but there are a bunch of other smaller housing finance companies that are reaching for the skies. And likewise insurance, only one listed player, but there are other conglomerates like SBI and Kotak which have insurance companies within them. Any of these plays will be an incremental target for you?
Well, they are all on the watch list. We look at the sector with great interest. But you've brought quite a few issues there and challenges within the financial space. We do have HDFC, we do have Kotak, we also have ICICI, for example. Mm-hmm. And we trim and we evolve our portfolio for different reasons at different points in time. I think the insurance opportunity is interesting, but it's expensively valued. I suppose you can make a case for having some exposure to get to the growth, but it's still evolving quite a lot. It's not evolving as dramatically as it used to about 5 years back. The players are more stable now. You have players that are far more focused on medium-term objectives and growing a proper business instead of just earning commission. So we think it's a healthier space to be in, but it's still not a cheap space to be in, and we will watch the space with interest. The other bit that's interesting that you mentioned about is housing finance. Yeah. And we have a lot of exposure in HDFC, but we also have mortgage exposures through our other holdings as well. We've had a look at the other financial companies, and just because there's a lot of choice doesn't mean you need to buy 5 companies. Ideally, what we try and do is we try and buy one for a particular idea. We try not to come to a clear decision on which is our preferred holding. There is a tendency in markets like India to explode your holdings, expand your holdings and hold 200 companies because there is so much choice. But I think it's far more useful to be very clear about what you want. And far more difficult to come to that decision.
Sure. I just want to get one more sector in, a sector that you've been bullish on for a while, which is cement. And within that, you know, you've liked stocks like Grasim, but there's been so much wealth created in some of the non-index large caps, the India Cements, Heidelberg, Shree Cements of the world. Anything else that interests you in that space?
We hold Grasim, but the purest play we have is actually in Ultratech. We do like bits we do have a bit in Ambuja as well, and we have a small bit in ACC. So those are the 4 holdings that we have that have cement exposure. So Grasim, Ultratech, ACC and Ambuja, those would be the names that we would hold.
Okay. A final question to you, Adrian. You know, when you look at the markets, you have $1 billion invested here, and your company will have many more billions in other markets. All markets are challenging their previous valuations. what fears do you have? What is one big fear that might poop this rally?
It could be anything. It could be a tweet in the middle of the night.
Okay. Well, we take that. We take that.
We don't want it to come in the middle of the night, though. We prefer it to come in the morning.
But Trump's tweet will come for middle of the night for Adrian.
It won't come in the middle of the night.
Yeah, I agree. I agree. That can be. So long as it's a tweet, you can still take it. So long as it's not a missile. Thank you very much, Adrian Lim, for joining us with your thoughts on so many sectors in the Indian market. So, well, if you choose with care, then perhaps you will sleep well at night, provided no one is tweeting.